Danaher, then, is a stock that we have not talked about much, maybe very briefly, I want to say at all, but certainly not very much. It's a US company that has an awful lot to like about it, to be honest, and it's kind of out of fashion at the moment, so worth a look, at least in my view. Anyway, it's a growth stock, very much a theme for this particular episode, so we shall start in the place that we always start with growth stocks, for the things that really matter for growth stocks, which is, of course, the balance sheet. They have 16.5 billion in debt and 2 billion in cash. So about 14.5 billion in net debt, there or thereabouts. Cool. It's about 10% of their market cap. Also cool. Anyway, they operate in three main sectors. They operate in biotechnology, they operate in life sciences, and they operate in diagnostics. So this is a healthcare bits and pieces company of a sort. And what they do in pretty much all of these is providing consumables and services and instruments and tools and things like that go into either hospitals or studying DNA or drug discovery, depending on which segment you're looking at for this. These are, of course, heavily regulated. This company looks a lot like Sartorius, so see recurring revenue, repeat business. See also, at the moment, just lately, big challenge has been large amounts of destocking due to huge over-inventory builds during the kind of COVID-19 pandemic. Both of those companies have seen their share prices go up an awful lot as demand got kind of yanked forward when everyone was busy trying to work out vaccines for everything. And both of them have now seen their demand go backwards and their share price go back to where it started and in some cases below as people decide not to buy anything at all because they've already got a massive pile of all these things and what do they need them for? And also, the US is not super vaccine friendly at the moment anyway, so Big Pharma is struggling and Big Pharma is kind of the customer if you sell all this stuff. Okay, so what that tells us about Danaher is that earnings are all over the shop. Just lately, they were far too high not that long ago, and they're now far too low compared to where they are normally. And when earnings are all over the shop, I tend to think that price-earnings ratios are not a good way of measuring, well, basically anything in this situation. So I look at price to book, and that's currently at 2.88. The low over the last 5 years is 2.67, so it's not far from that territory. Before that, it went through a period of trading slightly lower, but this is close to a kind of 5-year low for this firm on that kind of more stable basis. Whether that number is low or not intrinsically depends on a couple of things. It depends on exactly what return on equity it gets, which is mid sort of low teens, maybe. It depends on how much it's going to grow. So we can say that there are at least some growth expectations for this thing, but they are much more modest than they have been over the last few years anyway. Danaher, though, is an acquirer, and it's a kind of interesting acquirer. We talk a lot about these sorts of companies, and you can add these into the list of portfolio things that we've discussed. And earlier on this episode, for anyone that's listening to the long version, there was Halma, and there's also been Diploma, and there's also been Judges Scientific, and to some extent there's also Berkshire Hathaway, and there's Bunzl, and they all do kind of different things, but they all have the same sort of business model, which is to say, you acquire businesses, you run them as decentralized conglomerates, you let people get on with running their own operations here, and you largely stay out the way, you look to acquire at decent multiples, and you just sit there and do nothing. But there are differences between some of these businesses. So there is differences firstly in the industry, but we all look for similar things. We look for kind of strong positions in niche markets, which makes you hard to disrupt. And ideally some sort of nice regulatory barrier to entry that stops any old body coming along and doing the same thing, but cheaper. And there are also different methods of thinking about how you want to integrate these things. So down the one end, you can basically try and integrate them quite a lot, which involves firing nearly everybody and using your existing people to run this business as well. And down the other end, there's doing absolutely nothing and just letting them get on with it. And both of them have their pros and their cons. Of the companies we've looked at so far, Danaher is towards the end of doing more stuff with the companies it acquires. It has this thing called the Danaher Business System, which is an interesting story behind this, very interesting story behind Danaher in general, actually. Well worth a listen and a look if anyone sees it. But the Danaher Business System is basically built around a kind of lean manufacturing idea and continuous improvement and a kind of focus on consistently moving forward and making progress. And they have a central office that does effectively help new subsidiaries or indeed existing subsidiaries keep working on these things of driving forward. There's a kind of story that they went off around the world. This is built on the Toyota production system, I think, where they went off to various parts of the world to see manufacturing in action because this used to be a tools company. And they Looked at GM taking 6 weeks to change a 2-ton die in their factory, and then Toyota changed the same thing in 6 hours. And they thought, okay, these guys are onto something here. We should work out how to implement some of these, and had a good, careful think and came up with the Danaher business system, which has subsequently, well, they initially kind of integrated it into their tools manufacturing operation. They've since then spun the tools thing and turned themselves into a kind of healthcare supply thing, and that's operation, and that's how they kind of keep moving forward. They are a constantly evolving company that right now they say they're kind of in iteration 4.0 of their company, and what the next iteration will look like, they don't know. Maybe it'll be this, maybe it'll be something a bit different. But a feature of having a business system like this, where you plan to improve things quite a bit, as opposed to where you plan to just largely leave things as they are and just add them onto your business in a sort of bolt-on style, is that you can acquire at higher multiples because you plan on getting more in the way of cost synergies and savings and so on and so forth. And they've recently bought Abcam, this is back in 2023, which was a UK company, I think, at around 32 times EBITDA for 2024. That's a big number. Whatever you think, wherever they are in the kind of cycle here, 32 times, well, cash profits, if we call them that, is not cheap. So you need to be thinking that you're going to get some progress out of this. But if you have a big thing like a Danaher business system that will help you improve businesses, you can afford to kind of pay higher multiples, and that will make you more competitive, versus if you are just going to buy this business and plonk it there in the style of a sort of diploma or a Judges Scientific type operation. Well, you'd perhaps better be thinking more that you're not going to pay much more than sort of 9 times EBIT in this case, because otherwise you've only got the business you're getting here, and if it doesn't grow much, then that's not going to do well for you. Your return on invested capital or whatever is going to go down. This comes from kind of a background of professionalizing industrials and making them more impressive, and then spinning them out here. But I think it's an interesting time to be looking at Danaher. I think this is a promising business. It's down quite a bit from where it was, and multiples-wise, it's definitely down from where it was. I sort of wonder whether this sort of ever gets cheap, and I wonder whether it maybe doesn't need to necessarily, because its growth prospects might be strong enough. There is enough of a culture in there and enough of a success story to... I'm almost thinking about it here. Steve, what do you think of Danaher?
So when I was looking at I was just looking at the chart, as lazy as that is, and it reminded me of, Stephen. Maybe you should, maybe you pull this up while I'm doing it. But I was looking at it thinking, that chart looks a hell of a lot like Thermo Fisher's if you put it on Max. So I just pulled up Thermo Fisher's alongside it, and Thermo Fisher has had a pretty awful year. I think it's down about 25%. But yeah, that chart looks really similar, like a proper steep incline and then some choppy water after that kind of period. And it just so happens that Danaher is like 150 billion and Thermo Fisher is a bit bigger at 156. So they really have kind of followed each other in a kind of interesting pattern. And that sort of got me comparing the two of them. And I think the Danaher business system is really interesting. You said lean, I would have said Kaizen, just because that's what sort of came to mind. Or maybe lean Kaizen. I suppose it's probably a little bit of both. But yeah, it's a focus on continuous improvement. So like you said, Steve, it's about getting strong companies and teaching them how to be even better. And when we talk about these kind of roll-up companies that do this kind of thing, Danaher is the sort of big proven entity that's been doing this for the longest. So I was pretty impressed. I mean, they've got a really good track record of improving operating margins and generating strong cash flow for these businesses. So yeah, really, really impressive looking business. But yeah, I was just sort of like looking at that sort of P ratio, saying, look, we're at 40. And then I'm drawn back to Thermo Fisher again. That's at 24. And Danaher, bit of growth pulled forward. Thermo Fisher, obviously, same problem, bit of growth pulled forward as well. And I just wonder who's the better buy, Steve. Danaher, or whether it's a basket of both if you was going to do something like this. It's a tough one, I think. It's an interesting business. It was on my watch list back in sort of 20, I don't know, I think 2020 or something like that. It was way on that massive upslope where it went from being about $90 to being about $300. And it was obviously it was that massive rise that caught me. I thought I'm going to have a look at this and see what's going on. And I didn't buy it at the time, but I thought I'd leave it on the watch list and eventually removed it because I just thought this thing just trades at a 50p forever, and it's a kind of mature-ish business, so where we should maybe really sort of consider its earnings as something we should put fairly high on the list of how we would value it. But yeah, I think it's quite an impressive business, and strange how it's followed Thermo Fisher and also now mildly interested in Thermo Fisher, Steve. What do you think?
Thermo Fisher might be one for next week, from what I'm hearing of this, Steve. If you'd bought Danaher 5 years ago, that would have been sort of mid 2020. You'd have done okay. You'd be up a bit. You'd have underperformed the S&P, I think, in that time because the S&P had a couple of very good years in there. And Danaher, you probably have outperformed the FTSE 100 and underperformed the S&P 500. So about the right kind of stock for me, I guess, in that case, on that basis. It looks a lot like Judges Scientific, doesn't it? Except it's, as far as I can tell, almost 300 times the size of Judges Scientific, which is quite big. And that's where you start kind of maybe... I think two things when I think this. One is that, okay, I'm not worrying about size. I wasn't worried about size for Judges Scientific anyway, to be honest. It's way too small. But the big kind of US successful, high-performing conglomerate things, they do get to be a big size before they start running into any sort of difficulties. I'm not even convinced Danaher's there yet. It's a kind of bet on the healthcare industry, but we've talked about a few different, without picking a winner, I suppose, is the big advantage of this. But we've talked about a few different ways in which you might be interested in US healthcare, and stocks there do look kind of cheap at the moment. We've talked about Pfizer before. I'm umming and ahhing about Danaher as against another name in that space. It isn't Thermo Fisher because I haven't actually thought of it yet, but I might well have a look before next week. I'll also maybe tell you about the one that I'm sort of comparing Danaher with as a possibility when that comes around. So maybe that's enough of an incentive to tune in again next time. Shall we knock it off there, Steve?
Yeah, just going to say the other thing I guess we can just sort of add into why these guys are having sort of choppy periods is the JFK effect as well, which has obviously taken some of the sort of emphasis. Is that what his name? What's his name? Robert F. Kennedy, RFK.
Junior, yeah.
Yes, RFK. Yes, the RFK effect, who has obviously taken some of the kind of eyes that were on biotechs and that kind of thing. Some of the money has just withdrawn a little bit from it because of the sort of uncertainty that he brings in regards to the healthcare industry. So yeah, that's just one of the other things to consider as well. It's not affected anything like Eli Lilly, Steve, but we will see.
You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.